It's time to dive into the exciting world of capital gains tax in India. From its humble beginnings in 1956 to its current status as a crucial revenue source for the government, this tax on the profits earned from the sale of capital assets has a fascinating history. Let us together explore the twists and turns, exemptions and deductions, and ever-changing rates of this important tax. Whether you're a seasoned investor or a curious beginner, this is one story you won't want to miss. Capital gains tax has always been a topic of discussion. It is a tax levied by the government on profits earned from the sale of capital assets such as stocks, bonds, real estate, or other investments. In India, the history of capital gains tax dates back to 1947, when the Income Tax Act was introduced. There are hopes that the government may make changes to the current capital gains tax structure with the 2023 Union Budget. India has come a long way from debating whether capital gains tax will discourage investment to introducing several regulations on how to impose tax in various scenarios. Let's take a look at the key events in the history of capital gains tax starting in 1991, the beginning of a decade of economic reforms in India. The sole purpose of the capital gains tax was to discourage the speculative activity of purchasing and selling assets during an inflationary period. The tax was first imposed for capital gains made between 1st April 1946 and 31st March 1948. However, in 1949, the tax was abolished because it was thought to have hampered stock and share transactions. The capital gains tax was made permanent in India by the Union Budget of 1956-1957. To boost tax revenue, the then Finance Minister T.T. Krishnamachari restored capital gains tax with a few changes. What steps were taken to acknowledge inflation? In 1991, capital gains on all three asset classes, equity, real estate, and gold, were taxed at the individual applicable slab rates. Then, in 1992, the then Finance Minister, Dr. Manmohan Singh, agreed to the Chalaiya Committee's recommendation to implement an indexation system, which raises the cost of long-term asset holdings during economic inflation. For equities, the holding term to be eligible for long-term capital gains was 1 year, whereas for gold and real estate, the holding period was 3 years. Later, in 1999, former Finance Minister Yashwant Sinha set a 10% maximum tax on long-term capital gains for equities. As a result, a taxpayer had the option of paying 10% without the benefit of indexation or 20% with indexation for long-term capital gains on assets. Why is the long-term capital gains exemption in 2004 considered a revolutionary move? In 2004, then Finance Minister P. Chidambaram removed the tax on long-term capital gains on the sale of listed shares and introduced the securities transaction tax, which is a small tax levied on the value of the purchase and sale of stocks. From 2004 until the long-term capital gains tax on equity was reintroduced in 2018, the number of demat accounts in India increased from 66.7 lakh to 3.4 crore. In the budget presented in 2004, P. Chidambaram reduced the rate of tax on short-term capital gains on listed equity to a flat rate of 10%, but raised this to 15% in the 2008 budget. What changed in the year 2018? In 2018, former Finance Minister Arun Jaitley decided to eliminate the nearly 14-year-long exemption for investors on long-term capital gain shares. Since that time, long-term capital gain over Rs 1 lakh has been subject to a 10% tax without any indexation. However, all gains made up until January 31st, 2018 were made tax-free up to that point. How dividend distribution tax became a topic of discussion? The introduction of the Dividend Distribution Tax or DDT by Chidambaram in 1997 led to a debate whether it was fair to tax dividends at a rate that was higher than what low income taxpayers paid, but lower than what high income taxpayers paid. The debate continued for years. In 2016, Jaitley found a middle ground and introduced a tax of 10% on individuals receiving dividends over 10 lakhs per annum while retaining DDT. This was aimed at preventing persons in the high income groups from paying taxes at much lower rates on dividends. But Finance Minister Nirmala Sitharaman reintroduced the classical system of taxing dividends entirely in the hands of shareholders. In her second budget speech in 2020, this also put an end to DDT in India. What 2023 looks like for capital gains tax. Moving forward, the capital gains tax system for different assets is anticipated to be adjusted in Budget 2023, both in terms of holding period and tax rates. We must wait and watch if 2023 can make an impact on India's capital gains tax history.